journey and you're theirs too. I swim with tea when they turned in. The staring down to mute and can learn to pull that sunk he died.
Let's begin with one of the most common mistakes made by owner-managers: paying personal expenses through the corporation. At first glance, it can seem harmless. The shareholder receives a personal bill, perhaps for a family vacation, personal shopping, a home renovation, or even a personal cell phone upgrade. Instead of paying the bill personally, the shareholder submits the expense to the corporation and uses corporate funds or a corporate credit card to pay it. Many people assume that because the corporation paid the expense, it automatically becomes a business expense. That assumption is one of the biggest traps in owner-manager tax planning. The CRA does not determine whether an expense is deductible based on who paid the bill. Instead, the CRA focuses on the true nature of the expense. The key question is simple: was the expense incurred for the purpose of earning business income, or was it primarily personal in nature? If the expense is personal, the fact that the corporation paid it does not change its character. A family vacation remains a family vacation. A personal shopping purchase remains a personal shopping purchase. A home renovation remains a personal expense if it relates to the shareholder's home rather than the business. This is why CRA auditors carefully review receipts, invoices, supporting documentation, and the surrounding circumstances. They are trying to determine whether the expense genuinely relates to the business or whether the corporation has simply paid a personal cost on behalf of the shareholder. This distinction is critically important because the tax consequences can become very expensive. In many cases, a personal expense paid by the corporation does not qualify for a corporate deduction. And if the corporation has provided a personal benefit to the shareholder, additional shareholder benefit rules may also apply. We'll examine those consequences in the next slide. For now, the most important lesson is that the corporation paying an expense does not automatically make that expense deductible. The CRA looks beyond the payment itself and focuses on the substance of the transaction. The key takeaway is simple: always separate personal expenses from business expenses. When personal expenses are run through the corporation, they often create tax problems that are far more costly than simply paying the expense personally in the first place. Now let's see how the famous double tax problem actually happens. This is one of the most expensive mistakes an owner-manager can make because the same transaction can create tax consequences for both the corporation and the shareholder. Let's walk through the process step by step. The corporation begins by paying a personal expense on behalf of the shareholder. Perhaps it is a family vacation, a personal purchase, a home-related expense, or some other cost that has no real connection to earning business income. The corporation records the payment and may even attempt to claim it as a business expense. At this point, everything may seem fine. However, if the CRA reviews the transaction, the analysis changes. The auditor examines the receipt, supporting documents, and surrounding facts. The CRA then asks a simple question: was this expense incurred for business purposes, or was it personal? If the CRA determines that the expense was personal, the first tax consequence occurs. The corporation loses the deduction. Because the expense is not considered a legitimate business expense, the corporation cannot deduct it when calculating taxable income. As a result, corporate taxable income increases. Higher taxable income means higher corporate tax. That alone is already a negative outcome. But the analysis does not stop there. The CRA now looks at the transaction from the shareholder's perspective. Since the corporation paid a personal expense for the shareholder, the CRA may conclude that the shareholder received a personal benefit. This is where subsection 15(1), the shareholder benefit rules, often come into play. The value of that personal benefit may be included in the shareholder's income. As a result, the shareholder may also have to pay personal tax on the value of the benefit received. Now notice what has happened. The corporation pays more tax because the deduction was denied. The shareholder pays more tax because a taxable benefit was created. The same transaction has triggered tax at two separate levels. This is what accountants refer to as the double tax result. The corporation suffers a tax cost. The shareholder suffers a tax cost. And neither party receives the benefit they originally expected. In many situations, the combined tax burden can be significantly higher than if the shareholder had simply paid the personal expense directly with personal funds. That is why experienced tax advisors are extremely cautious whenever personal expenses appear in corporate records. The key takeaway is that paying a personal expense through a corporation does not make the expense deductible. Instead, it can create the worst possible outcome: corporate tax on one side and personal tax on the other. This is the essence of the double tax trap, and it is one of the most common issues discovered during CR audits of owner-managed corporations. Let's bring everything together with a practical example of the double tax trap. Imagine a shareholder takes a family vacation that costs $10,000. This is clearly a personal expense. It has nothing to do with earning business income. However, instead of paying for the vacation personally, the shareholder has the corporation pay the bill using corporate funds. At first, this may seem like a convenient way to access corporate money, but from a tax perspective, this is where the problem begins. The CRA reviews the transaction and asks a straightforward question. Was this vacation expense incurred for business purposes? In this example, the answer is no. The vacation was personal. Because the expense is personal, the corporation is not entitled to claim it as a business deduction. As a result, the corporation loses the deduction. This increases corporate taxable income and causes the corporation to pay more corporate tax. That is the first layer of tax. Next, the CRA examines the transaction from the shareholder's perspective. Since the corporation paid a personal expense on behalf of the shareholder, the CRA may conclude that the shareholder received a personal benefit. Under the shareholder benefit rules, the value of that benefit can be included in the shareholder's personal income. As a result, the shareholder may also have to pay personal tax on the value of the vacation. That is the second layer of tax. Now compare the two possible outcomes. If the shareholder had simply paid the vacation personally, the total cost would have been the $10,000 vacation expense. End of story. But when the vacation is improperly paid through the corporation, the situation becomes much more expensive. The shareholder still receives the same $10,000 vacation. However, the corporation pays additional corporate tax because the deduction is denied. The shareholder may pay additional personal tax because a taxable benefit has been assessed. And together, those taxes can significantly increase the overall cost of the vacation. This is why accountants often refer to this as the worst possible tax outcome. The shareholder does not obtain a valid business deduction. The corporation pays more tax. The shareholder pays more tax. And everyone ends up worse off than if the expense had been handled correctly from the beginning. The lesson is simple, but extremely important. Personal expenses should remain personal expenses. Business expenses should remain business expenses. Trying to run personal costs through a corporation may appear to save money in the short term, but it often creates a far more expensive result once the CRA reviews the transaction. That is the essence of the double tax trap, and one of the key reasons why proper separation of personal and corporate spending is essential for every owner-manager.